Welcome back to FinWise Now, your smart guide to the future of finance, crypto, and macro trends. Today, we're diving into something urgent and something big. Why is the U.S. government suddenly embracing crypto? Is it about innovation? Is it about freedom? Is it about empowering you, the individual investor? Spoiler alert, it's none of those. The real story is more complicated and a lot more consequential. At its core, this isn't about disrupting the system or bringing power to the people. It's about saving the U.S. Treasury. Let's break it all down. Not long ago, Washington was basically at war with crypto. There was a time when the mere mention of Bitcoin or Ethereum at a financial institution would raise eyebrows and sound alarms. As a former financial advisor, I remember those moments well. We had to tell clients, stay away from crypto. It's a Ponzi scheme. And here's the thing. We weren't saying that because we truly believed it, or because we thought it was bad for you. We said it because we were legally required to say it. Financial advisors, for all the talk about working for the client, are ultimately agents of the system first. The rules were clear. Crypto was considered too risky, too unregulated, and too much of a threat to the established order. Even the loudest critics think Jamie Dimon at J.P. Morgan were on record calling Bitcoin a fraud. But fast forward to now, and what do we see? J.P. Morgan, one of the biggest banks in the world, is offering Bitcoin access to its clients. Morgan Stanley is doing the same. The landscape has shifted almost overnight. So, what changed? Was it a sudden belief in the power of blockchain? Was it a newfound respect for financial freedom? Or was it something else entirely? Let's be clear. This shift is not about freedom. It's not about innovation. It's not about protecting you as an investor. The real motive is much more pragmatic and, in some ways, desperate. The U.S. government needs crypto to support its dying treasury market. This isn't speculation, it's policy. Secretary Scott Bessent recently put it out in the open. We believe there's up to $2 trillion in demand for U.S. treasuries from digital assets in the coming years. That's not a prediction. That's a strategy. Why would the U.S. suddenly see crypto as an ally? Because the national debt has ballooned to unprecedented levels, over 120% of GDP and climbing. As the debt grows, interest payments take up more and more of the federal budget. Traditional buyers of U.S. debt, like China and Japan, are quietly pulling back. The Federal Reserve can't keep buying treasuries forever without lighting the fuse of runaway inflation. The government needs a new, hungry buyer for its debt, and it has found one in the crypto ecosystem. Enter stablecoins specifically, USDT, Tether, and USDC, USD coin. These are not just dollar-pegged tokens floating in the digital ether. They are backed in large part by U.S. treasuries. Here's how it works. Investors park their money in stablecoins for reasons of convenience, speed, and access to the crypto economy. The issuers of these stablecoins, companies like Tether and Circle, take that money and buy U.S. Treasury bills. It's a system that mirrors a money market fund, but turbocharged by the global reach and 24/7 nature of digital assets. The numbers are staggering. Tether, for example, now holds nearly $100 billion in U.S. Treasury bills, making it one of the top non-sovereign holders of American debt. Every new dollar that flows into stablecoins is a new dollar flowing into the Treasury market. So, while crypto users might believe they're moving outside the traditional banking system, the reality is their dollars are being funneled right back into it, propping up the very system they thought they were escaping. It's financial jujitsu at a global scale. To formalize this relationship, Congress is pushing the Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. This legislation requires stablecoin issuers to maintain reserves backed by safe, liquid assets, primarily U.S. treasuries. On the surface, it looks like a move to protect consumers and bring order to a chaotic market. But don't be fooled. If the goal had truly been to protect you, this regulation would have come years ago, long before the collapses of FTX or Terra sent shockwaves through the industry. The timing makes the real motive clear. This is about securing a steady, reliable demand for government debt. It's about keeping the Treasury market afloat. Why does this matter? Because America's debt situation is at a breaking point. With the national debt above 120% of GDP and with traditional foreign buyers stepping back, the government is running out of options. The Federal Reserve, which has been buying treasuries to keep interest rates low, is boxed in by the risk of inflation. There's only so much money printing you can do before the value of the dollar starts to erode. Now the government is turning to the private sector specifically, to the capital parked in crypto stablecoins to fill the gap. They want your stablecoin dollars to hold up the U.S. economy. This isn't a story of crypto winning the war against the establishment. It's a story of crypto being absorbed by the very system it set out to disrupt. The embrace of stablecoins isn't about technological innovation or financial freedom. It's about survival. The U.S. needs a new source of demand for its debt, and the crypto markets flush with liquidity and global in reach are the perfect candidate. So, what should you do with all this information? Don't get distracted by the hype or the headlines. Understand what's really happening under the surface. Focus on education, risk management, and protecting your capital. The rules of the game are changing, and those who understand the new dynamics will have the edge. And if you want to learn strategies to thrive in uncertain markets, check out our next deep dive where we break down the Black Swan strategy, an approach that returned over 1,700% in just 11 days. Remember to like, comment, and subscribe to FinWise Now, your unfair advantage in the world of digital finance. Stay smart, stay aware, and stay ahead.